The 1920s, known as the Roaring Twenties, saw America's economy appear to enjoy boundless prosperity. The stock market became a national frenzy, with millions of ordinary people pouring in, dreaming of getting rich overnight. Margin trading was rampant. People borrowed money to speculate in stocks. Leverage amplified gains but also planted hidden dangers. From 1921 to September 1929, the Dow Jones Industrial Average soared from 63 points to 381 points, inflating a massive speculative bubble. However, wealth distribution was extremely unequal. Agriculture suffered from overproduction. Industries piled up unsold inventories, and consumer purchasing power was inadequate. In August 1929, the Federal Reserve raised interest rates. A mild recession emerged in the summer, revealing cracks in the economy. On September 5th, the market suffered the Babson break, with the index falling sharply. Warnings were sounded but widely ignored. On October 16th, renowned economist Irving Fisher declared that stock prices had reached a permanently high plateau. On the afternoon of October 23rd, selling pressure exploded, and the market began a free fall. October 24th, Black Thursday. The market plunged 11% at the opening, with 12.9 million shares traded. Panic spread rapidly. Ticker tapes lagged severely due to extreme trading volume. Investors could not get timely price updates, fueling further panic. Leading bankers held an emergency meeting and decided to have Richard Whitney step in to prop up the market. Whitney made large-scale purchases of blue-chip stocks, temporarily stabilizing the market, which closed with only a modest loss. A slight rebound followed on Friday, and bankers declared the crisis over. October 28th, Black Monday. Panic reignited. The Dow plummeted nearly 13% on volume of 9.21 million shares. Leveraged investors faced huge margin calls they could not meet, triggering a wave of forced liquidations. October 29th, Black Tuesday. The market opened to violent selling from the start. Trading volume hit a record 16.4 million shares. The Dow dropped another 12%, wiping out tens of billions of dollars in total value. General Electric fell from 396 to 210. RCA collapsed from 505 to just 26. No blue-chip stock was spared. Lifelong savings of thousands of investors vanished in an instant, and despair enveloped Wall Street. The stock crash triggered bank runs as depositors rushed to withdraw funds, sparking a liquidity crisis in the banking system. President Herbert Hoover and Treasury Secretary Andrew Mellon claimed that the fundamental business of the country is sound and prosperity is just around the corner. By mid-November, the Dow had lost nearly half its value, and the crisis was far from over. After a brief rebound in the spring of 1930, the market crashed again in May, and confidence completely collapsed. Banks failed in succession. Thousands of banks went bankrupt between 1930 and 1933, and credit froze nationwide. Businesses slashed production and laid off workers on a massive scale. The unemployment rate surged from 3% in 1929, leaving millions jobless. In July 1932, the Dow bottomed at 41.22 points, an 89% drop from its peak, the lowest level of the 20th century. Unemployed people gathered in Hoovervilles, as poverty and hunger became daily reality. The agricultural crisis worsened. Farmers were displaced due to crop surpluses and crippling debt. Millions of Americans lined up for bread and soup. The social safety net barely existed. The crisis spread rapidly across the globe. The gold standard amplified contagion, and world trade collapsed. In 1933, Franklin D. Roosevelt took office and launched the New Deal. Measures such as the bank holiday and strengthened securities regulation were gradually implemented. New Deal programs including public works and Social Security eased some suffering, but recovery was slow. The Dow Jones Index did not regain its 1929 peak until 1954. The trauma lasted for decades. The Great Depression lasted nearly 10 years and only truly ended with the outbreak of World War II. The 1929 stock crash was not the sole cause of the Great Depression, but it was a critical trigger, exposing excess speculation, weak regulation, and deep structural economic flaws. It serves as a warning to later generations. Excessive leverage and blind optimism can destroy an entire economic system. After the crash, the U.S. strengthened financial regulation and established institutions such as the Securities and Exchange Commission, SEC. The Great Depression reshaped the global order and influenced subsequent political and economic trajectories. Countless families were plunged into poverty, and social trauma passed down through generations. The combination of ecological and economic disaster accelerated mass migration. The crisis exposed the fragility of the financial system and widespread social injustice. From Hoover's limited intervention to Roosevelt's New Deal, the role of government was fundamentally transformed. Regulatory reforms helped restore rationality to the market, but at a heavy cost. Military demand during World War II finally pulled the economy out of its slump. Looking back on this period today, we can still draw profound lessons. Bubbles, leverage, and regulation are factors requiring vigilance in every era. The Great Depression forged America's resilience and spirit of reform. History does not repeat itself, but its lessons never grow old. The 1929 Wall Street crash and the Great Depression stand as the most profound financial and economic lessons of the 20th century, worthy of eternal remembrance.